To time or not to time? That's the question we're going to be answering today when it comes to market timing versus dollar cost averaging. This is Personal Finance Boss, and welcome to another episode. So, Ali, what are the two options when it comes to deciding... I already said them, right? Anyway, when it comes to deciding when to buy in the markets or not.
Okay, so there's dollar cost averaging, which is just essentially averaging the cost that you paid for your holdings.
Okay, what's an example of it?
So, for example, let's say I bought 10 shares of TD at $70 on Thursday, and then Friday morning it dropped to 66. So now,
and why did it drop?
It dropped to 66 because of a teller probe and saying that their tellers would wrongfully direct their clients. They would open up not open up accounts for their clients, but increase their lines of credit, increase limits on their credit card, suggest higher account fees. Their advisors as well apparently would push clients into non-suitable products. So that's another reason why you shouldn't go to the bank advisor and do it on your own, and you'll save on the fees at the same time. And
anyway, enough bank bashing, even though we love doing it.
We should have an episode on bank bashing. That would be fun.
Yeah, it would be fun.
That would be fun.
Because I was a teller for 9 months, and boy, do I have a lot to say about that.
But anyway, back to dollar cost averaging. So if I bought 10 shares of TD at $70, then it dropped to $66. Now, as if I wanted to dollar cost average, I would buy 10 more shares, for example. And now my price now paid overall for the shares would be $68.
Okay. I believe there's one mistake in what you said.
All right.
You wouldn't buy 10 shares at a lower price. I think
I would buy more shares at a lower price.
The same dollar amount at a lower price, which means that if you were buying more than 10,
that's true,
you'd be able to buy more shares, right? So I have a question for you guys. And you should probably get a piece of pen and paper. What? Well, for you guys, yeah. If you buy a stock, but it seems kind of obvious since we're talking about it now, but if you buy a stock, or if you buy $100 worth of a stock at $10, right, you get 10 shares, right?
Yeah.
Say the stock goes down to $7.50, and you buy another $100 worth. The numbers don't matter. It's all qualitative numbers, or whatever. And then say the stock drops to $5, and then you buy another $100 worth of the stock. Okay? When the stock goes back up to $7.50, which was the middle point between the highest point of the stock, or your initial buying price of 10, and the lowest point, which was 5, did you make money, lose money, or break even? Now, I've honestly gotten all three answers to this question because, people didn't sit down and do the math. But long story short, you actually make money because you buy more stocks at the $5 mark versus at the $10 mark. And since the $7.50 is in the middle, it doesn't really matter if you purchase there then or not. But you end up making money because when the stock goes from $5 to $7.50, there's more stocks that you buy at a cheaper price. So you make money. Now, that's the argument for dollar cost averaging. And what's great is that you don't need to know what's going on in the world. You don't need to know what's going on in the markets. Don't need to follow anything. You just blindly say, okay, every 2 weeks, I'm going to purchase $200 of this ETF or of this stock. Sorry. Or whatever other asset.
Mutual fund or whatever.
Whatever you want to buy. And then if the stock goes down, you're happy because you're buying in it cheaper. And then if it goes up, you're happy because you're making money. So either way, it's kind of a win-win. Unless you want to pull your money out, then you obviously don't want the price to go down. But if it's going down, you buy cheaper. So in the future, since the stock market returns positive, or at least in the States, if you look at any 10-year period, you're always up, right? So it's good news if you get to buy cheaper. The second theory or idea or whatever you want to call it.
Ideology,
sure. Is market timing. And for 95% of the people, I wouldn't advise market timing because
it can drive you insane.
Yes. And to be able to time the market, you kind of need to know what you're looking at and what you're looking for and what type of indicators you need to look at to time a market. So,
and another reason for market timing also is you can spend hours and days just waiting and being hesitant on what time to actually enter the market, as opposed to dollar cost averaging. That's more of a automatic process that
but market
gets
timing,
it for you.
Market timing could even be over months, right? If you're an index investor and you're just waiting for a dip, like a dip in the S&P 500 to then buy in, you may be waiting for a month or for 2 years. Like you don't know how long you'll be waiting for, and that's one of the things that I don't like about market timing when it comes to something as general as that. Now, if you're a technical trader and you're waiting to see certain patterns in the graph of a stock, then it's completely different. But for the purpose of this podcast, we're not going to be talking about day traders or sophisticated investors that follow macroeconomic news, look at the news announcements like the job claims, jobs report, like new car sales, home starts, stuff like that. We're not going to get into all those indicators. They're indicators, right? Or like data points or whatever. We're just going to really go with basic, okay, there's a dip, let's buy the index, it's high, let's sell, and then let's buy in at the next dip, right? So the reason why one would rather dollar cost average than market time would be the fear of missing out, right? If you're waiting, let's say the SPY is at 200 and then it's at 210, 220, 230, you're like, oh man, I'm losing out all of this money. And then I bet you that when you buy, that's going to be the peak, and then it's going to start going down. But that's one of the reasons why dollar cost averaging is much easier when it comes to psychological states, since you set up rules at the beginning and you follow them and you don't question them and you don't act in irrational ways based on irrational market movements.
Yeah, and even if you're going to tell yourself like, okay, I'm going to put this dollar cost averaging, but what happens if I always buy high and then at one point when it's time to buy it, my dollar cost averaging is supposed to be for the next week, the automated process to buy it's supposed to be for next week, but the stock is down today. It can always be a good idea at that point maybe to keep a little bit of your portfolio, maybe like 5 to 10% of it in cash, so that if a market opportunity were to come up, you could just go ahead and buy it at that point too. But keep that dollar cost averaging process already active. Let that run through. You won't have to fret over, oh, it's high today, I should sell. It's low tomorrow, I should buy. And another thing which I don't like with market timing is that we as humans, we always get greedy. If we're saying, okay, I'm going to buy JP Morgan stock, for example, at $50, and it hits 50, you're like, you know what? It can hit 49. I can buy it at 49, and then you get into this cycle of waiting, and then when it hits 49, you're like, okay, it's going to hit 48, but then it takes off to 55. Yeah. And you're like, oh crap, I should have bought it when it hit 50. So we get into this cycle of being very greedy and we lose out on some of these opportunities.
Well, just something to go in favor of market timing. If you're better versed in, let's say, the whole technical analysis scene, let's say you wanted to buy the position at 49 because you observe certain metrics in the graph that say, at this point, there's going to be strong support, so it's going to be really hard for the stock price to go below this level. You can initiate a position, and then if you see in the graph that if the stock passes 51, then it's going to for sure hit a new high. I don't know what it is, but it's going to at least go up 2-3%. Then you could say, okay, I'm going to buy in, let's say, 50% at 49, and then if ever it makes it past 51, I'll buy in another 50%. But you need to have these set of rules before you start making the trades, because if you're reacting,
if you're overreacting.
No, it's reacting, and there's anyways, if you panic, that's not good, and you're going to make mistakes. So same thing with dollar cost averaging, like Ali said, if there's a dip, sure, you can maybe buy more on the day of the dip, but the problem with that is you start meddling with your stuff, and then you tell yourself, well, why am I buying if it's down? It's counterintuitive. I don't want to lose more money. I want to sell. Right? So if you start allowing yourself to play with what you buy and what you sell and this, that, the other, you're going to probably end up buying at highs and selling at lows.
Yeah.
Like we've done in the past.
And another problem with that, it's not only that you're losing money from selling high, from selling low, buying high, all of those wrong things is that it also costs every time you make a trade, it costs you. And depending on the brokerage house you're in, it can be anywhere between $5, $10, sometimes even $15 per trade.
Yeah.
So in a day that you make, let's say 5 mistakes and your trading is $5, each way is $50. So you've just lost out $100, and on $1,000 portfolio, that's a 10% return in one day that's gone. And so it's very important that when you're making these moves, it's calculated. And that's why dollar cost averaging is actually such a great way. By automating the process, you're going to take this entire worry strategy of, oh, it's at 49, I'm going to buy it. And then 48, I'm going to buy more. You take out this entire strategy, just automate it, and you're getting the best deal out of it anyway.
Yeah. And since, if you can find platforms where you can buy ETFs for free or other securities, but we recommend doing ETFs because why would you, and unless you have inside information, it's much safer to just go with ETFs just for the reason of diversification, which we will dedicate a whole episode to. But on some platforms you can buy them for free, so it saves you a lot of money in fees.
Yep. And I think another good thing with mutual funds and ETFs is even if you do dollar cost averaging, you can actually buy portions of units as well. For mutual funds, you can buy portions.
Yeah,
of
not
units.
ETFs.
For ETFs, sorry, but for mutual funds, you can actually buy portions of units. So
there's another pro for mutual funds. Great.
Yeah, that's another pro for mutual funds. But yeah, some people, they may not have enough money to buy one share of, I think, like a Dow Jones ETF from Vanguard, which is maybe like $200 US per unit.
The SPY's at 240 now, I think.
240, yeah. So if you don't have enough for 240, but let's say you have enough for a mutual fund that's $240 and a similar one, you could even put 50 and you could buy portions of units and accumulate them that way as well.
Yeah. Well, this was a nice short and sweet episode on
dollar cost averaging and market timing.
Yeah. So to summarize, I personally do a bit of both. I dollar cost average, and then I try to time the markets depending on what happens. A good example was Brexit.
Yeah.
The stocks tanked for some reason. I was scared for those poor British folk. And then it went back up. I don't know, it took like a couple of weeks.
Yeah.
Then you made a nice 10 percent. But it could have also went the other way, and it could have tanked further.
Yeah.
So it's a risk that you take. But at the same time, that's how you make.
It was the same after Trump got elected and the futures went down 900 points. Carl Icahn left the party and bought some shares. So that was an example of market timing. And if you feel, like we mentioned, if you feel like you're going to miss out, keep a little bit of your portfolio in cash. It doesn't have to be a huge chunk because cash has no return, but maybe 5 to 10% for portfolio in cash. And that way, if any opportunities do come up in the market, you can go ahead and pick them up, and you won't feel sorry that you missed out.
Yeah. Boom. Great. Thanks, guys, for listening. We covered the topic, I think, pretty well.
Yeah.
And we'll see you guys in the next one.